final trading day of the week and on a Friday. What an interesting day we had yesterday. One of the most enjoyable mornings I can remember in a very, very, very long time. It's almost, I couldn't believe what was happening when you walk into the office and all of a sudden you're seeing normal European equity market open, but only to see that happen in 2017, so that was nice. This was triggered off by a number of reasons, as I'm sure Anthony discussed in the afternoon session, but my sort of spin on it is the markets took a little bit, well, they regained some humility yesterday, remembering that markets can tumble, or what a sombering reminder it is to mark the Black Monday, the tumble that we saw in the Dow Jones over 3 decades ago. And then I think that is one of the main reasons, people just remembering that equity markets can go down, they have gone down in the past, and that in itself just reminding people maybe booking some profits at these incredibly elevated levels is probably not the worst idea. We were seeing this in all your major US equity markets, with your Dow Jones taking a tumble, S&P taking a tumble, as well as your Nasdaq taking a bit of a hit as well. But the way that I think some of the more experienced guys I know were looking at it was, fine, you can take the short on the way down, but this was a flash sale, and that's the best way to look at it. This was a flash sale. Everything was 0.2% off, and in today's markets 0.2% is a huge discount. Nasdaq was down, about 1%. So I think the Dow, just get the numbers out here, 0.6%. So yeah, we were trading marginally lower, and this in itself was just a great opportunity for anyone who was unwilling to buy right at these highs here. Price retraced. This is a great opportunity to go long, and I think Vas was getting into a few long positions on the way up, just playing market sentiment. So that was a good trade. Now, I personally, I know you should stay flexible and dynamic, but I'm not too comfortable shorting equity, so I took a slightly different trade, which I've discussed with you guys on a number of occasions. I went short the dollar yen. I've found recently that the short dollar yen play works a lot cleaner, especially when you're going on a risk-off move, money flowing into the yen, taking the short through to pivot. We hovered around, adding to the position here, closing my position out around what day was this? It would have been Thursday's highs, not taking the full amount of the move. But it was good to see the guys in the live room were doing pretty well. The guys in the third stage of the program took this trade really, really well. Some of them making some of their best days so far, very early in the morning. On that note, I would like to say that if you've had a good morning, just watching the brief yesterday, it was good to see that the live guys called it a day. I've made my money, it's time to walk away. But this sort of psychology also filters through into the next day. If you had a really good day yesterday, all too often, the next day is where people come in, they'll tax themselves in the morning, then they'll tax themselves a little bit more in the afternoon, then they'll end up giving all of their winners away. This will make them start to gamble, and as they start to gamble, they'll lose more money than they made yesterday. These are not fun coupons. This is your profit and loss. Hold on to it for dear life. I mean, make sure your next trade is better than your last, and that's the way to approach this. Not now I have 100 tokens to play around with. So a really interesting morning. That was just the sort of sentiment-driven market as the equity market sold off, seeing a flow to haven. Following this, we saw the Eurodollar take a bit of a tumble, as we can see here. Around 8 AM, we fall all the way down quite sharply through to your pivot level whilst we're trading at R1, and this is as you see the Spanish government basically go to say that they're going to be looking to invoke Article 155, I believe, on Saturday. Now, my sort of views on this are a bit mixed. I think the Catalan president did a really, really good job of showing a bit of defiance by sort of taking a very politically correct stance by saying, look, the Catalonians have voted to claim independence, but I want to keep talks open, so he was just holding off on triggering independence. Spain came back and played hardball, saying you have till yesterday or Thursday to either tell us if you are or aren't claiming independence. I think if the Catalonians or the Catalonian leadership was being serious on Tuesday or Wednesday, they would have come out and said, that's it, I'm not having this. we're going to declare independence. But the truth of the matter is, ultimately, if they take that step, well, all of the leadership in the Catalonian side is going to be up for legal battles and issues and may end up in jail, and I don't think they want to do that. So the Catalonian president then went on to say, if the Spanish government persists in blocking dialogues with the Catalonian parliament may proceed to approve formal declaration of independence. That's quite a big step from, pushing through with a referendum of which was sort of being fought against on even the European level and the Spanish level, but being defiant. That was a really strong claim. And now to say we may push forward with our independence, I think this is going to turn into a non-event. I don't think anybody wants this situation to evolve any further. We saw the IBEX down 0.74%. This is a bit different to the 2.2% moves that we were seeing when this situation was first developing. So I think Saturday is going to be interesting to see what the Spanish government decides to do, and whether the Catalonians fight back in the weeks following. But I just feel like these are, in the end of the day, politicians who have families, wives and kids, and they don't want to end up in jail. And maybe that's me underestimating them, but I just don't think the communication from their side has been particularly strong on that front. So that was the euro. Following on quite quickly, we had retail sales from the United Kingdom. So the year-on-year average was at a 4-year low. So the situation continues to deteriorate in the United Kingdom. We've seen cable has been coming under quite a bit of pressure most recently. Sort of definitely stopping with this upside trend, some heavy downside definitely in play. Retail sales, however, wasn't the easiest data set to trade by any means. If we bring it down to a 1-minute chart, we're hovering around the 1.32, and it's just interesting for some of the newer guys. You'll see the market gravitates towards nice round numbers or handles or a pivot level ahead of data and stalls, and then the data comes out, and even though this is a minute candle, actually that move was over in about 5 seconds, 10 seconds, maybe 15 seconds, much lower than 1 minute. Not really managing to retrace to S1 at any given moment. So that move was basically dud. I did take in a short, getting stopped out quite quickly on that trade. It was quite a difficult move to catch hold of. I think this is where it's almost like if you wanted to catch a hold of that, it's if Inga's here, investing.com, try to beat it, see the red candle, get involved, would have been the best method. But obviously not understanding the totality of the data and then getting involved is a bit more risky. But that's the only way I feel like you may have been able to can't get a hold of this move now. As you guys know, I'm not the biggest tech analyst there is, but the 50% fib working very well here. This is sort of the only time where I promote maybe the use of Fibonacci, but me personally as an intraday trader, I don't use it very often, but moves like this, it can become quite interesting. Fibbing the move, 50% retracement. My theory on that is that the algos can fib faster than the humans can, which make it in itself self-prophesizing. Following on from sterling, well, we've still currently got a 80% likelihood of a hike going through in November by the Bank of England, and this is just following the minutes that were released during the last interest rate decision, and this is sort of in line with the fact that we're getting 3% inflation, which is the headline, and that's what everyone's talking about. 3% inflation. We know if we get a 0.1 increase, we need the Mark Carney then needs to go speak to the Chancellor of the Exchequer, and then we're also seeing, I still think anemic wage growth is an appropriate way to put it, as Mark Carney put it. So on one side, yes, inflation spiraling out of control, around 3%. But then the issue is that wage growth is quite slow. So if you start hiking interest rates and business confidence falls and people aren't willing to invest, then you may see that wage growth continues to decline as opposed to start to improve. Following this, the retail sales are obviously pretty poor. Now, if you start to increase people's if mortgage repayments start to go up, retail sales are only going to slump further and further and further, and the consumer loses confidence. We've seen just last night, let me flick over the charts, we saw the Bank of England, Deputy Governor Cunliffe said on Thursday it was not clear that interest rates need to rise soon, showing at least 2 of the central bank's 9 policymakers are likely to vote for a hike in November. We also seen some uncertainty with Mark Carney not speaking not sounding too confident about this rate hike, which is a bit different to the minutes that were released, where they were quite hawkish in their rhetoric. So we're seeing uncertainty within Bank of England Monetary Policy Committee members, and then on the other hand, there's uncertainty there, while we've also got 80% probability of a hike. I think this sort of dovish rhetoric which is coming out from these Bank of England MPC members is more to manage expectations, because an 80% likelihood, and we've still got 2 weeks to go till we're in November. I think we've prematurely overly priced this hike. In 2 weeks a lot can develop, and especially with this Brexit situation, which is another matter altogether. Don't want to spend too much time on it, but we did see Theresa May being thrown. I haven't got the news headline up, but Theresa May being thrown a bone by Angela Merkel. I mean, it's just depressing. Now Angela Merkel is obviously, the general elections in Germany are over, and now she can start playing a bit more of an active role in this. But I still say it to this day, I wish we had Angela Merkel leading our country as opposed to Theresa May. I think it would have been definitely better. And I think if people keep asking, well, who's the alternative, I'll come out and say I think David Cameron should come back and just for a couple of years get us through this Brexit negotiation, and then he can go and retire in peace and go back to the private side. Fed up of Theresa May and how weak she is being. I mean, neither of the Catalonian leadership or the UK leadership have watched House of Cards. I would strongly suggest them to spend a weekend away just watching House of Cards so they can learn how to get on with this thing called politics. On politics, we also saw something happen at 2:30 yesterday, and that is the markets, in my belief, act irrationally to. By the way, guys, keep an eye on oil. Just seeing a bit of pressure on my screen. What we saw yesterday was Donald Trump managed to push through his fiscal budget for 2018. So with a vote split of 51 to 49, the market took as a positive, basically saying that this is one hurdle that Donald Trump had to overcome. Now that he's overcome this hurdle, he can then focus on the tax plan. My point is, we weren't going to go into 2018 without a fiscal plan, but this is just the irrationality of the markets. We dipped yesterday, any excuse whatsoever to drive the market higher, and we saw a continuation of the Trump trade. So just quickly flick over to the charts and just talk about the Trump trade, which I'm sure you guys are all familiar with. We saw gold here, 230, coming under pressure, indication of dollar strength. We also saw the euro come under pressure, cable lesser so, but we were already trading quite low. We'd already been under pressure for the session before. Dollar strength over here, so broad-based dollar strength. And if we get the Dow Jones chart over here, this is interesting. Coming into the US close yesterday, we were hovering around the highs, obviously having that flash sale, people buying, booking some profit here. Coming into a relatively liquid time of the market, people may have been looking to go short there to play a bit of a range. Trump manages to get his fiscal budget through. See a little modest uptick in sentiment, and then we may have broken those stop losses being triggered, but really holding on to those gains, which I find quite surprising. I think this was of course fundamentally driven, but also if you look at it on a 1 minute chart, there was a technical aspect to this trade. We're opening here, we're finishing at the highs, we're opening here, we're finishing around the highs. It's very aggressive buying considering the time of the day, so I felt this was more, there was an aspect of technical trading in here as well. But we are hanging on to our highs for now, so definite retracement down to these levels looking quite interesting. So equity higher, dollar higher, and then final part of the Trump trade is yields higher, therefore T-notes needed to come under pressure. And we can see here T-notes under pressure. So dollar higher, yield higher, and equity higher. Donald Trump, the Trumpflation trade very much in play. Okay, so that was the Donald Trump situation yesterday. Apart from that, we got a relatively quiet session ahead of us. There's one last point I wanted to just talk about, and it seems like Yellen's on her way out. From somebody that Donald Trump didn't like during his campaign, to somebody he did like and had a lot of respect for, to somebody who is on the table. I think it is now decided that Janet Yellen, some of his advisors are basically saying Janet Yellen is on her way out and she's going to be replaced with towards Taylor or Fed's Powell. In terms of these two, Fed's Powell will be more of a continuation of Yellen's approach, which is cautious hawkishness, and Taylor being on the more hawkish side of the spectrum. And let's have a quick look at the calendar today. So it's a Canadian trading, it's a CAD trading day today. You got Canadian inflation numbers coming out. So you got your CPI inflations for the month of September, and obviously in the late part of October. So I'll be cautious of those numbers. But given the fact that the Bank of Canada did hike surprisingly, did take the market by surprise by hiking a little earlier in the last quarter. Keeping an close eye on those inflation numbers to see how and if this hike is now starting to filter through into your inflation numbers. You've also your Canadian retail sales, so month on month, and ex-auto readings there. For any of you trading the CAD, there's obviously quite key numbers. In terms of speakers, Fed's Mester speaks on global regulation structure. Doesn't sound particularly interesting on a markets front or just generally attendance-wise. Fed's Yellen speaks on monetary policy since the financial crisis. That is at, well, that's already come and gone. It's at 12:15. Sorry, midday. No, 12:15 in the morning. No, that'll be 12:15 tomorrow, so Sunday morning. Otherwise, earnings, Schlumberger, Volvo, definitely something to keep an eye out for. But otherwise, yeah, it's a relatively quiet trading day. I would also like to say here that given the fact that the data calendar is quite light, of course we're going to see some CAD traders in the market. But people had a good day yesterday. It was some of the best moves we've seen. Well, simply, it was one of the best moves we've had all year in terms of the morning, apart from sort of the French election days where the European session used to be a bit more interesting. People would have done pretty well. The afternoon session, I imagine, got a bit choppy, but people would be looking at the calendar last night and saying, well, I've had a good week. Is there any point of me coming in today? So we may see lower volumes, a bit of choppy price action. For any of the newer guys, once again, just be cautious. There's no point giving all your profits back if you had a good day. Okay. Well, that's your wrap, guys. Thank you very much. If you have any questions, please. Oh, one last thing I wanted to look at. As you guys know, I've been talking a lot about this really beautiful correlation between sterling and the FTSE, and I tried to bring something new and interesting. You can see, look at this inverse correlation. So you got your red and green here, which denotes your. So this is cable at the top here. So cable going up, you can see perfect inverse correlation with the UK 100 over here, and then over here you can see as these are converging, the FTSE is rising. Apologies, Jimmy. So this is me just saying that really perfect inverse correlation. So much so that it was really noticeable for about a month or two that any pressure in sterling caused immediate upside in FTSE, and this is quite a common relationship between obviously a domestic currency and a domestic equity market. But I think since Brexit, we've seen this, and particularly in more recent times of volatility in the sterling currency, we've seen this inverse correlation become stronger and stronger, whereas almost the perfect lead indicator. If you want to know what FTSE is going to do, look at sterling. Sterling breaks R1, FTSE comes under pressure. So it's been, and if you look at this chart here, look how perfectly inverse correlated they are. This is, what did I say this one was? This is the FTSE 100, so this is sterling appreciating, FTSE falling. Then they start converging. As sterling starts to fall, UK 100 starts to go higher and higher and higher. And you can see how well this correlation has been working for a period of a month. But then look at this. This correlation, it still exists in times of market volatility, but it's become a little bit less clear. It's sort of, you can see this correlation once again is starting to unfold over here as sterling comes under pressure. And you may say that it's just because the charts are a bit messy, but if you look at it a bit more closely, it's only when you're seeing these big moves that the correlation comes into place. That correlation, it's a bit upsetting because this has been a very, very good trade to take. Just trade the opposite in the FTSE 100 playing that inverse correlation. So I hope this trend and this inverse correlation continues onwards because it's been really enjoyable to play. So I'll be keeping a close eye on this. I have mentioned before how you get on and put this technical analysis on. Right click on your screen, add study. chart overlay. And just close this. So you go BP6. Put it on the time frame you want. Right click, chart analog overlay, and then you type in the product code UK100, and then you can change the color by right clicking, modifying. You can go ahead and do this for the DAX and Eurodollar and so on and so forth. But yeah, just keep an eye on that correlation. It's become a little bit weaker in most recent trade. But thank you very much, guys. Let me know if you have any questions. I'll be in trading live. Best of luck. Thanks.